Let's get to hot picks. On the agenda today, we've got big tech. Amazon is set to report first quarter earnings this week. That's on May 1st, Thursday, along with Apple. And investors will be closely watching to see what tariff effects there will be and will it show up in the earnings forecast from either company. Our guest has a buy on those two stocks. We're joined by Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management. Great to see you, Benjamin, as ever. Start off with Apple. You see potential there. You'd be a buyer of this stock with new money?
Yeah, that's right. So the story for Apple for us is, I think everybody knows the stock has underperformed like a lot of other big techs. The concerns for Apple primarily are tariffs. What are the impacts of tariffs going to be on their phones and on their inputs, cost of goods sold? And also with regards to AI, they're seen as potentially a little bit slower with regards to updates to Siri and Apple Intelligence. But for us, the big picture is Apple is extremely well positioned for a world where AI is ubiquitous. AI agents are ubiquitous for a handful of reasons. Number one, they should have superior performance. They have their custom silicon. They have their software hardware integration. They have this tight control of the Apple ecosystem. They have their reputation for privacy and data security that other companies don't really have at the same level. And maybe the most important is Apple is the company that actually has devices in the hands of consumers. So other AI companies that want to get their products in the hands of consumers, in a lot of cases, very likely it's going to have to go through Apple. We also think at the same time, tariffs are not really going to have such a huge impact on their bottom line. For example, the US is only about 35% of their sales. Most of those sales come from installments or carrier incentives. They have been able to secure trade exemptions in the past. They're working to shift production to India. And if it comes down to it, or when it comes down to it, we think they have the pricing power, the ability to raise prices if they need to. And bottom line, we think it's still a great company. The valuation is very reasonable, trades at about 28 times forward earnings. So for us, this is still an attractive proposition.
But aren't the tariffs a major threat if they have to curb their manufacturing in China? I mean, we've seen these calculations of the massive cost if they had to make this stuff in America.
Yeah, so I mean, I don't think anybody really knows what's going to happen there with regards to the tariffs. But our view is, if anybody is going to be able to carve out an exemption or get some way to make it work, we think it's going to be Apple. And we think that if anybody's going to figure out a solution, even if the tariffs do stay, even if they do stay at a level that's prohibitive, we think Apple's going to be able to figure it out.
As you note, they do have pricing power. They've always been able to charge rich prices for their devices. Google, you put new money into this one as well, Benjamin?
That's right. So Google announced last week. We thought the earnings were quite strong. We're seeing some significant positive trends for AI. We're seeing an increase in user engagement. We're seeing an increase in what advertisers are willing to pay for their ads. That's from Gemini, these AI overviews when you make a search, other ad placement algorithms. So it's a positive trends there. We think that the disruption risk that's seen from ChatGPT and other large language models, we think that's probably overblown, despite the hype. Pardon me. We think they've done a good job managing search, while at the same time, a growing share of their revenues is coming from other places, coming from things like YouTube and cloud services. Cloud services is growing at double digits. It's solidly profitable. And going forward, we think that capacity build-outs are going to be tightly tied to demand, so we don't think it's going to be hugely expensive for Google. And at the same time, you put it all together, we think it's still a fabulous business. The stock is, in our view, very, very cheap, traded at about 17 times earnings, so significantly lower than a market multiple. Like the other big techs, like every company, it has risks, but we think it's on the whole, it's a very attractive proposition.
And finally, we're tight for time, Benjamin. You'd be a buyer of Amazon as well?
That's right. So they're announcing this week as well. They're in the news today because they want to add tariff impacts on their prices on Amazon.com.
Apparently, sorry, Benjamin, to interrupt. They're now saying we only considered doing it on Amazon Whole, which is their new low-cost website. So the story is evolving. But carry on, please. Right. Sorry to interrupt.
Right. So the White House is not very happy about the idea, regardless of what form it eventually takes. And so there's potential for Amazon being under the crosshairs, so to speak. But Of course, that's unknown. We don't know how that's going to develop, but we think Amazon is going to figure out a way to make it work. We know that Jeff Bezos and Donald Trump are, at least for now, they're buddy. But the company itself, we think that Amazon retail has had a phenomenal turnaround since COVID. Their margins are now at all-time highs. Their margins are about 8%. Delivery speeds are faster than ever. They're delivering 60% of deliveries same or next day. They think they can continue to improve their margins from incorporating more robotics. They don't think, they being Amazon's management, don't think that tariffs is going to be a huge impact for them. Sellers are likely going to be the ones that have to absorb most of the price impacts because they're so reliant on Amazon's logistics and their customer base. Amazon Web Services margins, we think, are going to continue to improve. They think they can be as good as on the AI side as traditional AWS margins, which is very encouraging. And they've, of course, had a huge capital expenditure, $100 billion last year. That's going to start flowing through to their depreciation. And in terms of valuation, stock trades at about the same multiple as Apple, about 28 times earnings. And for a scaled business, of course, they still have a huge lead in retail and their wonderful cloud services business. We think it continues to be a very attractive opportunity.
Benjamin, thank you very much indeed.
Thanks for having me.
Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management.